So what will be the impact of change in interest rates on stock prices? So obviously there are so many variables that go into the equilibrium price of a stock. However, we're going to try to isolate the impact of interest rates by simply ignoring all other variables. Now notice there are a couple of dimensions to this. First of all, interest rate is not the only variable that defines the stock prices, obviously. And just even the expectation of interest rates is a variable in this function. And then there are so many different macroeconomic variables that define the stock prices. There are expectations of investors about all other variables that affect the stock prices. But all we really are going to do is just to provide an example of how investors price stocks with respect to comparable yields in the market. So the second dimension is the sensitivity of each stock to the interest rates is different, meaning as interest rates go up or down by 0.5%, the ExxonMobil or Apple or JP Morgan Chase will react differently to this change. We simplify by saying that they all act in a similar manner, and again we simplify by saying that their reaction will be the same. Now note that each company has a different sensitivity, and there are other variables that go into the calculation of this equilibrium price. However, our purpose is to provide an example of how a macroeconomic event, such as an interest rate, may affect prices. So we may not be precise, but this is the method in which the interest rates effect on the stock prices may be calculated. So I'll start a spreadsheet, and I'm going to be using Apple, JP Morgan Chase, and Exxon, not of any particular reason, but these are companies that have relatively low, or at least not too high, of PE ratios, so that makes it a little bit easier to show as an example. So I will start with their symbols. I need their earnings per share, I need their PEs, and so we'll have Apple, JP Morgan Chase, just to make sure, and then we have Exxon. So, and then we have their stock price. So Apple has a stock price of $190.15, and then it has an earnings per share of $11.89, which makes the PE as 16. Now JP Morgan Chase has a $109.16 of a stock price. Earnings per share is $9.27, and PE is $11.78. Now Exxon has a price of $74.58, and then earnings per share is $4.34, and the PE is 17.18. Now let's calculate. The PE is obviously the price to earnings per share. Let's invert that and make this as an EP ratio, and perhaps I should just make everything right. So, and then we're going to make this an earnings per share divided by the price, which gives us what we refer to as the yield. Now, if we take 1 over the 16, which gives you a 6.25% for Apple, and then 1 over the PE for JP Morgan Chase, which is 8.49, and then the same for Exxon is 5.82. Now, change in interest rate. If we change the interest rates by, say, 0.25% drop, then the new EP, so new EP based on this. Now, again, we're assuming that the companies' prices will have a sensitivity to the change in interest rate of equal amount. Again, this is an oversimplification. However, the method is what we're trying to understand. So we'll take the 625, that's the yield on Apple, and if the interest rates overall have a reduction of 0.25% because Fed decreases the interest rates, then it will be natural to assume that every other investment across the board will have a reduction in yield of a similar amount, similar level. So we'll have this, and then we'll have this, and then we'll have this. Meaning, Apple had an earnings per share of 6.25%. Now, after the Fed reduction interest rates of 0.25%, we would expect Apple yield to go down to 6%. JP Morgan Chase yield from 8.49% down to 8.24%, and then Exxon 5.82% down to 5.57%. Now, based on the new earnings per share to price, what will be the new price, right? So new expected price. So the new expected price would be the earnings per share divided the new expected yield. So new earnings per share, well, the actual earnings per share divided by the new expected yield, and the price will be 198. And then the same thing with JP Morgan Chase, 927 divided by the new expected yield, 112, and then 434 earnings per share divided by the new yield, and that gives you 77%, $77.91 for Exxon. So as you can see, the $190 of Apple would be expected to go up to $198 because of Fed reduction in interest rates of 0.25%. This is assuming that Apple will have the same reaction to, or the sensitivity to, interest rate change as much as the U.S. Treasury. So 0.25% in U.S. Treasuries will be reflected completely on the Apple's yield is our assumption. And based on an assumption, the price of Apple will go from 190 to 198. So if we had invested in this, so let's include a column, perhaps 2 columns. So if we include share value, let's say we included 100 shares of each, and then we had this much invested. Now, based on the new prices, the new value of our portfolio will be 198 times 100, and our total portfolio value then will be the total of these 3, and then our previous total before the rate cut was so the impact of this rate cut on our portfolio is portfolio value went from 37,389 to 38,858. So we have a net increase of $1,469.81. That's a net change. And then if we were to take the percentage change of this, this will be an impact of about 3.93% net change percent. So that is a net change of 3.93%. So overall, if Fed were to decrease the interest rates by 0.25%, we would expect stock prices to increase. Now, how much increase? We simplified it in this example, and we showed it based on their yield, which is earnings per share to price ratio. And we simply reduced that yield as much as the reduction in interest rates by Fed, and came up with new prices and calculated a new portfolio value. Now, based on this, our net change was about $1,500, which showed about 4% net change in our portfolio value. Now, the market's reaction obviously will be different, and every company will have a different sensitivity, but overall, the methodology is through the using these multiples, and in this case we use the PE. Again, obviously when we use the earnings per share, when Fed decreases the interest rate by 0.25%, they decrease it because they are cautious about the economic growth, and there's an expectation of a recession. Now, that expectation alone will create a pressure on stock prices because a recession or economy in a recession will have a negative impact on revenues, and therefore overall income, and therefore overall earnings per share. And even though everybody's very happy about Fed decreasing the interest rate, proactive Fed, free money, all that is great. However, it is ultimately because the economy is doing bad, and bad economy is bad for revenue and therefore bad for earnings per share. So in the long run, expectation is for these companies to lose value. However, from the current political and economic climate, it looks like as the Fed decreases the interest rates, the same will actually be true for all other investment choices, and that would actually be reflected on prices, and that would actually be reflected on our portfolio value. So that is an example, a simplified example of an effect of change in interest rates on our portfolio value. Thank you.